This is Satya Pradhuman of Cirrus Research. Welcome to our quarterly outlook call. A lot of the comments we're going to be making in this call have been taken from our quarterly outlook. That's the dispatch report. Please feel free to look at that as we're going through some of the notes. In this session, I'll have a number of the key charts up on screen as well. But foremost, Happy New Year. Welcome to our quarterly call. What we've been through, I think the word tumultuous is one of the words, horrific is another, and the list goes on. Technically, 2022 was a bear market. The numbers are not pretty. S&P was down roughly 19%. Dramatically, bonds were off by 13%. There really was nowhere to hide. The VIX was ranged anywhere between 16 to 38% annualized falls. The bond market volatilities were even far greater, between 72 and 160. But to give you a sense of the real pain in the market, the leadership of the prior few years truly continued a breakdown. So NASDAQ, again, was down about 33% for the year, and the Russell 2000 was roughly down about 22%. So the bottom line, though, is that this was a very, very challenging period. It was really, we've used the term triple threat, and the idea was that a lot of things came together here. One was the surfacing and the reality of an inflationary backdrop, a world in where we really don't have a handle on when it settles down. Also, most professionals have no practice in dealing with an inflationary backdrop, unless you've been, managing money back in the 70s. The reality, though, is that you had the inflation story. You had the Fed continuing to hike rates and really remove liquidity. A lot of the support system that was in place for the pandemic, eventually those were going to be removed. And so that's running its course as we speak. And then finally, probably the ultimate curveball in all of this, because if it wasn't confusing enough, we also had to deal with the Ukraine invasion. Now, it sounds like, when you're talking about the market outlook, why not mention any war that surfaces? Well, this one is a big deal because it basically hit the overall commodity markets in a major, major way. So when we look at global markets, the U.S. was the weakest markets of most of the major markets we track. I guess Russia was weaker, as it's now closed. Ironically, Latin America and India were some of the strongest markets, with gains in the 6 to 10% range. And we'll talk a little bit about that in a second. And that will tie back into the CapEx theme that we've really been publishing quite a bit on. But at the heart of this was the energy sector was by far the strongest. Depending on which asset class you're looking at, the range was somewhere between 57 to 76% in gains. And by the way, utilities eked out a year with a gain. So when you're looking at those two sectors as sort of like the constructive ones, we also had on the other extreme major drawdowns, consumer discretionary and tech. Those groups were down 37 to 40% range. So we understand this sort of gut-wrenching change that's underway. So the aggregate numbers don't reflect a lot of the drama that really took place that active managers had to face this year. Lots to cover in this call. I'll certainly do my best to kind of move it through and really cut to the chase. But we'll talk a bit about some new research on liquidity studies. We'll talk a bit about risk capital in this call. Clearly, we're going to address market valuations, the small cap growth, the small cap market, the profit cycle, and why we continue to focus on quality. And clearly, after a year, 18 months of really being in a sort of fetal posture, it is time to play offense, and we're going to try to walk through some of those themes. We've certainly been echoing them in the last 6-12 months or so, but we'll take a closer look at it. But before I do that, let's jump into how we framed this environment pretty much in all of 22. And I believe, at least for the first half of 23, we're going to remain in what we call the barbell posture. A lot of this has to do with a few simple things. One, the profit cycle is peaking. And as a result, we have to focus on earnings visibility. In addition to that, we've got some uncertainty with margins. Margin pressures have been severe. So what we're looking at is a world where profitability is going to be rewarded. So this idea about quality growth would make sense. The curveball, though, has really to do with two ongoing elements that forces a deep cyclical run. One is an ongoing break in innovation multiples and elevated commodity prices. So as a result, one of the areas we've really focused on in here is what we call the IMEs, industrial material energy. We'll talk quite a bit about that in a bit, but at the heart of this is also a way of playing offense. So this barbell strategy, it's a tough one to come up with because you always want to have a nice, simple strategy. So yeah, if you have two things you're talking about, it basically says, oh, you're hedging. But honestly, this backdrop was fairly extreme, and you had two very, very different things moving in their own course. And as a result, I think the barbell posture remains. We like it. It worked, and I think it's going to work again in 23. Let me get into the profit cycle. This purple curve here represents top line growth for the market. The thin blue line represents estimates. And at the end of the day, no one is surprised that the economy is slowing and the profit cycle is slowing. Let me make one really important distinction as an investor. We're not here to forecast a recession. I think there's going to be plenty of people forecasting the recession. If you're running money, I don't know if you need to focus there. What you should be focusing on is whether profits are going to accelerate or they're going to slow. And the degree in their slowdown is really how defensive we get in the portfolio. So this idea about debating the recession call, I think it's nice to do. It's, if you're on TV, I guess maybe you should talk about it. But in terms of running the portfolio, let's get down to the business. In terms of this profit cycle rolling over, we are just getting started. If we look across most markets, that's a very consistent signal we're seeing. Potentially the weakest rollover we've seen is emanating from China, and followed by Europe, and the US seems to be the most stable as it's rolling over. And the heart of this is that this is likely to continue. The Fed is not done, and as a result, these comps are going to get tougher. So that's something that really forces the quality bias. There's no mistake about, you've had this sort of surge, this sort of a post-pandemic surge in growth. We're now unwinding that, and we're also dealing with margin pressures. Another component to the barbell strategy, though, is this idea on, regarding quality, I should say. If you look at this curve here, it represents the performance of quality high versus low. So these numbers look fantastic. What you're looking at is really since the fall of 2020, higher quality firms came back in a roar. These numbers are a little stacked because underneath it, the denominator of low quality are a ton of the innovation shares that really, really blew up. So clearly, what I don't want to do is over make the case, but the reality is that this market has avoided speculation, and if we're right, as the profit cycle slows, it's going to focus really on earnings visibility. So that's this next chapter that's coming. We learned quite a bit in some of the special reports we published on quality. One of the cool things that we were able to sort of decipher in this quality story was that, hey, is it working everywhere? And it's clearly not. When you look at for instance, the performance by sectors, in this instance, what we did was we took a couple of the key tails of the market. On one end, we took tech and healthcare, sort of your classic leaders of the pandemic world. And then we looked at the other end of energy, materials. And the thin blue line here is really the market as well. But really, actually, the purple line, sorry. But what you'll notice among the key sectors like healthcare and tech, higher quality has been dominant for a couple of years, right? So as the market sort of reverse course in 21, We saw higher quality strategies really take off. We saw a pause in here in early 22, but then it's come back again. And our message is that this idea of earnings softness is running its course. We are, I think, quite a bit more optimistic about the earnings work as we look forward here. But nonetheless, the slowdown is underway. It's probably being echoed better than it was just 6 months ago. On the other hand, when we look at the commodity groups and quality as factors did not work. If anything, they were sort of like, flattish, not really making money, not really losing money. What I think we take from this is simple, which is if you're looking at sectors with pricing power, and the energy sector clearly has some pricing power. Who cares about whether or not it's a visible energy company? You're just getting exposure. These guys are making their top lines flying, and as a result, you win. So I think, if we're moving into a world where energy prices are more sort of stable, this quality rotation should also permeate these hard sectors. But really, it was super important to understand why quality may not work if that sector commodity, the underlying pricing, is actually accelerating. In fact, the opposite is very true for healthcare and technology. As you get a slowdown in the consumer, you get a slowdown in CapEx tech, all of a sudden margins matter a lot more. Ultimately, we talk a lot about whether or not we can, how well quality has performed, and many clients will come up with the important question is, well, how much further? I mean, after all, markets do price in a lot of things. This here is a proxy for pricing a factor. And in this case, we're going to value what quality as a factor moves at. So we're using EV to sales. We're basically saying, they trade somewhere between sort of parity, high quality, low, up to about, normally is like about a 40% or so premium or so. So at the end of the day, what we're showing here is that this reading is somewhere in the middling of the range. And as a result, quality could get more expensive as it did in 19 or right before the pandemic. So we are getting there. And this does tell me that, the sort of easy spreads that we witnessed back in 2022 is probably going to mature. The other side of it is, if we're right about quality and earnings, they'll probably earn their way into their multiples better than the low quality firms as we look out for the next 12, 18 months. One of the things that was very confounding for this sort of barbell call or the profit cycle peaking call was this, that quality as a factor across the capital market spectrum. So large cap, mid cap, small cap, valuations also work. And so the question is, why would value matter as the profit cycle slows? And at the end of the day, I think there are two moving parts here. One is clearly energy was a discounted group, so it's going to cause valuation parameters to look better. But two, bear in mind, the market, as the Fed continued to tighten, really punished high multiples. So you have two moving parts here. You've got a Fed that's reversing liquidity, and you've got a profit cycle slowdown. That's not really supposed to happen, right? Typically, a Fed would tighten to slow down the system. And to some degree, this is already underway. So I think this idea about focusing on valuations and that they matter, I think is going to be a resonant factor for all of 23, even if the Fed does at some point begin to fade their motion. Another key change in the platform or the system is this idea of sort of market leadership. And what you'll notice is that the small cap trending factors, really from mid 2021 to present, has really begun to take off. Whereas we had a massive underperformance of leadership in the larger cap arena. My suspicion is that what occurred was the breakdown of the most speculative names were most violent in the first year or two in the small cap market. We basically made a pretty big case last spring about how that should be spreading to the large mega cap names. And so to some degree, what made 2022 a tougher year was that some of the sacred cows started to reverse course. The extended FANG baskets, those names also weakened. So all of a sudden, what we're now finally seeing is a world in which the leadership bins are much more diverse. We've complained all year that the large cap leadership bin still looked like the pandemic leadership, that people were still chasing what worked. In the small cap arena, they had no luxury as such, just because the ARC related names melted down we're entering our third year of those stocks really breaking down. So this gap that we've seen in leadership, I suspect at 23, this is going to narrow, that the leadership portfolio today in large caps look very similar to the mid and small. Those portfolios are published every month in our signals report, at least the sort of exposures to them. Clearly the baskets are available upon request. But in terms of the outlook for markets, this idea about expectations, we've really harped about the earnings environment. In the title of the report, it was, focus on earnings, not the Fed. And I clearly do not want to sort of understate, how much of an influence the Fed has on market valuations. But I think in terms of the day job, it really is still a market about earnings, and maybe more so, because if you had easy money, then who cares about earnings when it's all about the promises? We have easy money, we can afford to go long duration. As the Fed is tightening, we clearly have reverse course, and all of a sudden earnings truly matters, and that's what's being reflected in market leadership. And so one really constructive element in this outlook for 23 is this idea about earnings expectations, that if you look at this thin blue line that's it's traced here, this represents basically the forward year estimates being revised. So if I see a number and it's scaled to the right, by the way, if I see a number in the 80 handle, that basically says 8 out of 10 estimates are getting raised. In other words, a terribly bullish world that basically peaked out in mid 21. And as this started to roll over, notice the rotation that we've made as of spring of 21 to quality. The idea was that the earnings expectations were going to roll over and quality should matter. The good news, though, is that while we've complained for quite a bit that the sell side consensus numbers were very slow to their adjustment, if you fast forward 12, 18 months later, this reading is now at a 30% level. Let me interpret this for you. It basically means 3 out of every 10 estimates are getting raised, or 7 out of every 10 estimates are getting cut. So not a pretty world, right? But the reality is that the consensus estimates are becoming much more in touch with gravity. And as a result, the earnings reporting season will still remain soft. Make no mistake about that. But the fallout in share prices should be far less dramatic, just because I think we all get the joke that the Fed really does carry a lot of weight, and the fact that easy money has a lot to do with where market multiples can trade. And that chapter has changed, at least for now. Another key point I want to flag is the fact that, clearly as central banks tighten, in fact, if you look globally, this was a record, the prior year was a record year in terms of the amount of central banks that were actually hiking rates. Clearly, the US drove the bus, and everyone else had to get on as a result, especially if let's say you're in Asia based and you're dollar pegged. You don't have a choice. Otherwise, your numbers, your currency begins to materially weaken. So at the heart of this is that, yes, we're no longer in sort of like 30-year lows in credit spreads. Well, surprise, right? I don't think we're shocked by that. But what is super interesting is that as spreads started widen by spring, summer, these numbers started to stabilize. And so at 4.25 in terms of high yield spreads over Treasury, these numbers are much more reasonable. And as a result, I do think this allows business to function, companies to get capital to go after projects. It's just not the free money it was. And maybe that's okay. maybe that's okay. So yeah, I think credit spreads we're watching very closely for any shocks to the system. And in terms of the sort of U.S. story, in fact, for that matter, Europe, I think these numbers look very constructive. The UK is a special beast, and we're actually our upcoming report is going to focus a little bit on this, so we'll get into that in that report. In addition to this, we've talked a lot about margin pressures, and this is a little bit of a few of the commodities that really have attacked consumers and have attacked companies. And so to some degree, these commodity prices are telling us that, okay, we may not be out of the woods, but the reality is that the inflation fears were really dramatically stoked by the Ukraine invasion, the shock to the system, and the filtering out into this channel. In addition to that, we've had how many bouts of shutdowns in China. So the supply chain has still been very slow to be repaired. And I guess we shouldn't be shocked if we're shut down. The global economy was effectively shut down for 2+ years. How quickly does it take to start back up? And so if COVID is not out of our vernacular, and to some degree, the supply chain issues will remain. It does seem to us, though, that is on the mend, and it is literally a matter of time. We're probably still have another year, though, of where the system is really going to continue to have its ebbs and troughs here with the readings. But like I said, I think this is a reason to be, again, a bit more constructive on absolute returns and equity returns. So to some degree, we're more heartened by the way some of the commodity prices have traced. In addition to that, speculative assets have broken hard. And so whether we're looking at SPACs, Bitcoin, even NASDAQ, to some degree, these asset classes that represent pure risk have retraced quite a bit, and to some degree, effectively shut down. So I do think this underscores our case for why the equity market becomes a little bit more tempered as we look out in 23. At the same time, we'll go through why the profit cycle is still slowing. So to some degree, we're still going to need to focus on finding good companies, good earnings, good valuations. A follow through on this is, to what degree are we looking at a bottom fishing for speculative assets? When you look at the underwriting data for the tech sector, and here we just pull this data out explicitly by sector, effectively, you've basically shut down the underwriting market. So maybe the buyout markets are going to really be the place to be. But in terms of issuing speculative assets, as multiples collapse, it makes no sense. So what does that mean? The cost of capital for speculative growth stocks are indeed really, really high. So while high yield spreads for businesses with cash flow are not crazy, super speculative firms, their cost of funding is really through the roof right now. So I don't foresee this improving overnight. And so this is a terribly important message because, as investors, we sometimes become enamored with the companies we own. And when we see them fall as much, it's so tempting to go after that falling knife. And I would argue that these names that are much lower today still represent falling knives more than anything else. When we look at our poster child for speculation, not to pick on any specific fund, but the ARC products basically earned the right to be the poster child just because they were able to successfully truly benefit from the free money moment of the pandemic. These multiples for one of the ARC products, prior to the pandemic, they traded clearly at a premium to the market. That's the blue line. But they traded somewhere between 4 and 6 times. With the pandemic and the Zoom world that we went to, these multiples started to climb to 8, 12. They peaked at about 15 times. We were fairly aggressive at flagging this marker here, saying with the economy opening up, people are going back to doing things, and the Fed at some point needs to reverse its course. These multiples could not sustain. We were somewhat surprised by how quickly this tumbled all the way down. I think it's got a 3 handle to it now in terms of the ARC multiple. The important point, though, in terms of looking out, I've given you reasons why I think you're in a more constructive zone. But take a look at the upper panel here, which is the extended FANG names. To some degree, this gap represents the holdovers. In other words, if tech IT spending continues to slow, it's really hard to see these multiples remain where they are, especially with speculative cost of funding really locked in right now. So moral of the story is I think there's still some more of this to come. I'll go through some comps in a moment. You'll get a better feel for this. But this gap here represents real risk in terms of the growth market, most notably the large cap growth. I think a space to watch in 23 that could be very constructive is small cap growth. The gap is historic, and it could be a major relative performance. It's still tough to see great absolute returns, but I think the spreads there are tremendous. Is it possible that large cap growth managers to stay in their growth box, continue to buy growth companies in the smaller cap arena to get better value? Why not? There are no sacred cows here in making money. I want to shift gears a little bit to this new body of work we've put together. Nick Pilar actually had a big hand in some of this work. This graphic here, a lot of credit goes to Georgiana Fung on the team. But the idea is that we took a study of the last 20 some odd years with Fed policies and easing and tightening. And what we learned that in an expansionary cycle, yes, you're in a world where the absolute returns are much better. That's really where we were in the last few years. As the Fed begins to reverse course, we begin to see absolute returns turning negative. That's clearly been the case in 22. The problem with this pure liquidity reading is that we're still here. If we're right in terms of reading the tea leaves of what the Fed is saying, we're still here and we're not here, right? And so to some degree, I think a lot of caution needs to be heeded just because we're pretty much still in uncharted territory. I will not try to pretend that we have a handle on where inflation is going. I do think some of the components of it are naturally going to work in our favor in 23, but the secular move in inflation, especially with what's going on in Europe and energy, that one's a lot tougher to call. So it's quite possible the Fed is potentially more determined just because you've got a historically low unemployment rate. And by the way, these unemployment rates are not unique to the US. The European unemployment rate is also at record lows. So to some degrees, the central banks have more of a luxury than we could imagine. So I do think we're going to tread with caution. We do think some of the innards of the market system are a lot more constructive. Let me shift gears back into the market valuations here for a second. This is a really important curve in the tech sector. It has quite a bit to do with how much of the adjustments we've seen in the smaller cap regime and how little of that adjustment we've seen in large cap land. So this is potentially where I think we'll continue to see the challenges. The problem with this story, though, is that those are the names with the market cap. So even though the market becomes more stable, if some of the biggest names are still struggling, guess what happens to your absolute returns? So we've used this phrase in the report. We've used it in a few conversations. We are truly in a market of stocks, and it is not a stock market. And I think that's super important. Maybe the rule or rubric out of all of this is that when the Fed is, giving you free money, it's the stock market, right? And when they're taking it away, it's a bunch of companies. And so maybe it's a good way to think about things. Let's take this thing a little further. Where are people going? Like the adage is, go to where the puck is going, not go to the puck. And so if the technology sector is coming down, this is looking at multiples going back the last 20 years or so relative to the benchmark. Where are investors and growth managers going to go? Because that's the marginal dollar that's up for vote, right? And so we have to watch this group. And to some degree, when you look at the contrast with the healthcare sector, I think this is massive. This is less dramatic in the small cap arena, just because the tech segment, aggressive growth segments have pulled back a lot sharper. But this is really what's driving market patterns, and we cannot ignore it. Let's take this a little further. When you look at the overall small cap growth, large cap growth comparison going back 30, 40 years, you're sort of in these structural low areas. And I think this is super important to bear in mind as investors, because you do not want to get too sedate about your bearish look or your bullish look. We've certainly learned the latter in the last few years. And so to some degree, we're going to watch the smaller cap growth arena, the small cap space in general. We're looking at historic breaks and valuations. There's still some headwinds here, especially with the profit cycle peaking and credit market still in turmoil. But the market's done a wonderful job to get us to a place where we should have fewer sort of headline risks. This is the follow through I promised, which was really the tech healthcare story in small cap land. Notice a much more nuanced take as we look out into 2023. But in terms of the equity market regime, this idea of like the IMEs on one end and the break in growth on the other, it couldn't have played out more dramatically in 22. I do think it'll continue to play out probably less drastically as what we've just lived through. I guess that's not hard to say, but yeah, I think in terms of active trades, though, when we look at I've used the phrase offense because we've been so busy talking about the profit cycle slowing, the Fed is tightening, inflation is here. We've basically been coaxed into sort of a fetal posture. But if you look forward, this idea of higher oil prices actually presents some real opportunities, we think. We've done quite a bit of work on infrastructure, the IMEs, as we call them. This panel is a case study of the 2002-2008 window, another period that might be very similar to where we're at. So in this window, it was after some major collapse in innovation shares. The purple curve here represents the tech sector, and the light blue line represents industrials. Down below represents the industrial spending data broken out by industrials and tech. And what you'll notice is that the industrial spending pattern reaccelerated for several years after the tech meltdown in 2000. And what you also saw was the technology spending data went dead. Now, technicians will say when you get a big market blow up, they had sold down, but then they rallied back in the 2003, but then completely rolled over. I think popularly, you could claim that it becomes dead money and we have to walk away. Underneath here, it sort of tells a fundamental story, which is, look, spending there in the 2000s was not accelerating for the tech sector. Why? Because of Y2K. Every CTO got an open check in the prior 2 years of the 2000s, and they spent it like crazy. The tech spending accelerated, and at some point, it fizzed. But this rotation in spending, I think, is important to bear in mind. That's what accounted there. Our call in this current period is that we are seeing the reversal in tech, and we've been seeing a slow, steady move in industrials. I think the latest moves have been clearly driven by energy, but we believe that this is resonant, and it is something that we really have to deal with over the next few years. At the heart of this case is that if we're in a world where commodities are higher for longer, industrial spending accelerates, technology spending is at the cost. This chart here, I think, is really neat. The purple curve represents oil prices going back to the 70s. The blue curve represents the industrial spending components. And what we'll see in other periods, major windows, was that in the 2000s, as an example, oil prices coincidentally went up higher. And guess what happened a year or so later? Industrial spending went up. It collapsed. Industrial spending collapsed. Here we are in a world where oil prices have rallied quite a bit, and now they've retraced a bit, but they're still structurally higher. And as a result, what this is telling us is that industrial spending will likely accelerate. Now, why would I make this case? And it's simple, that if you're in a world of higher commodity prices, plant equipment spending matters and efficiency matters. So a reinvestment in the CapEx cycle is here, at least for now. Part two is that you already had a glut of spending because of Y2K. I mean, we're benefited from being able to run this call now on this in this particular vertical because of the pandemic. One of the silver linings, I guess. But at the end of the day, this gap that's opened here, I think is going to close, and it's favoring industrials. So what do we do as investors? I think the sort of traditional fundamental manager will find the right place. If you're really stuck in a box like aggressive growth, what do? You're going to look at companies, ironically, oil services. You're going to be able to talk those names up because if their revenues climb, you're going to be there. So we've seen this before. Go back to 2002, 2007. Look at the portfolios of the average growth product. The rotations can be fairly dramatic if companies are making money. And then a follow through to this. This falls under a bigger banner of energy security. Because we're in a world of energy security, you have a ton of spending that will occur. Infrastructure will benefit from this. I mean, we've laid case on the infrastructure indices in the last 2 years or so. We actually built these indices coming as we were hopefully hitting near the end of the pandemic cycle. The argument we made was climate, underspending, and the adjustments we're going to need the post-pandemic moment all told us that infrastructure spending should accelerate. We've seen all these benchmarks sharply outperform. The absolute returns in 22 was not great. They were still down. But the moral of the story is that the underpinning, if you're in a world for commodity prices higher for longer, look out. This could be a meaningful rotation. This is not just a few months. And so one way of playing offense is focusing on this other segment, this grittier segment of the equity market. Another way, and this links back to our earnings statement in the title, focus on earnings. And so what we think will continue to work better are earnings torpedo models and fallen angels. In other words, if expectations are stupid high for companies, look out, do your homework, make sure they're in the right place. We publish this once a quarter. We have our own earnings torpedo models. I'm happy to share it with you. I think some of you already get this on a regular basis. And then the fallen angels segment. In the last year, I've sort of avoided using the term fallen angel just because you had so many, falling knives. But the idea now is that as estimates have really come down, we are beginning to look for opportunities and where the consensus went too far. Just like on the upside, it happens here as well. So when the consensus seems to hate something, they seem to really bludgeon it. So I do think we're getting closer to a point where both these models are going to be very effective as we look through 23. So in terms of, how do we bring this all together? To some degree, we use our active blend portfolios to make sense of the world, to put into play how we're framing the world. We have remained in this sort of, if I'm in the growth camp, we've remained in this GARP quality growth world. And then if we're in the value camp, we've really been in this relative value, quality value sphere. It's quite possible that the quality theme is unlikely to work as well as it did, at least the spreads in 2022, just because you had really speculative names melting down to zero in some cases. So nonetheless, though, I think we're in the right camp because the profit cycle turning, it just takes time. It's just not, the US economy, the global economy, they're big ships to turn. And I think as investors, we need to be patient. Let me tie this together in one of the outbursts, though, of these blends. What we noticed every month this year, or I should say in 22, was that these numbers, the performance of our active blends, surprisingly, all of them were doing well. And it was a little disturbing because we're like, wait a second, I know these models are decent, but inevitably you're going to get pockets of the models that really struggle. This chart here at the end, this was, by the way, published every month in our briefing, which is a market wrap up of our active signals, and also market summary. To my left here are the small cap growth active blends. So the thick blue line here is the quality, the purple line is GARP, and the thin line is aggressive growth. To the right-hand side are the value blends. So we've got the quality value in the blue, we've got relative value in the purple, and the thin blue line here is deep value. No surprise, I think deep value worked especially well, just because what you had here was a ton of the industrial material type names, energy clearly dramatic. And same here in aggressive growth, the trending portfolios in small cap land became super exposed to energy. And so, but one of the bigger things to think about, and we believe that good research should always try to connect the dots. There's all these things that are moving, and it can be a bit chaotic. Thanks to all the data we now have access to. But really, if you step back for a second, the profit cycle is slowing, the Fed is tightening, we've got some uncertainties on the horizon with inflation, and we've got this post-pandemic moment. What you've got is a lot of uncertainty, and you've got less capital. So by definition, you're in a world where fundamentals matter. And as a result, active strategies come back to life. Our quantitative models, I'm not here to toot our horn. I'm here to tell you that fundamental managers had a better relative performance here. The short book of hedge funds had a much better year. The quantitative models are working better. The factor data in general just behaves better. In other words, it's back to stock picking, fundamentals matter, visibility is important. So these things are all tying into one thing. The silver lining in this painful market is that the skill sets you have to run money are finally at the top of the list. And so I do, in terms of looking at 23, I'm cautiously optimistic about the value add of active management. So to tie this all together, focus on earnings, not the Fed. Our liquidity regime is a little bit of a downer. It is a wet blanket in the story, but the reality is the Fed's not done. Their resilience may reflect the resilience of the labor market. So, I think a lot of people are very quick to call recession. I think they're underestimating the power of historically low unemployment rate and the resilience of the consumer. Risk capital, it's still at risk. It's probably too early to bottom fish for innovation names. We're in a world where valuations matter. They've adjusted. Small cap growth are multi-decade low multiples relative to the larger cap brethren. These are all really good things. The things that don't change, we may debate inflation, we may debate the recession word, but the profit cycle is going to continue to slow. Earnings visibility is going to matter. Valuations will work. So how do we play offense in this? Ironically, focusing on quality. So focus on earnings, healthy earnings companies. This infrastructure thesis, the CapEx theme that we've talked about, it's a big deal. We've done the homework. We've published. The stocks are working. I got to think the big banks are going to start to talk about it as well. Focus on the torpedo models, the fallen angel models. Those things are also going to be super important. In your parlance, pay attention to what company management's doing. Pay attention to the margins of these firms. So with that, all the best for 2023. And thank you for joining us. If you were late, there will be a replay sent for this. And this will also be a market conversation slideshow on our YouTube channel. And thank you very much for attending.